Have you ever just found yourself staring at a stock ticker, with all those green and red numbers just flashing and dancing around, and you think to yourself, what is actually making those things move? Well, today, we're going to pull back that curtain and really get into what truly dictates stock prices.
I mean, that's the big question, isn't it? That relentless, almost chaotic flicker of numbers. It can seem so random, but I promise you, by the time we're done here, you're going to see the method behind all that madness. It's easy to picture some secret room where Wall Street titans just decide the price of a stock. But the reality? It's so much more interesting. It's actually a huge, live, public auction, a constant digital tug-of-war between thousands of buyers and sellers, and we all have a front row seat. So here's our game plan. First, we're going to crack the price flicker mystery. Then we'll open up the market's secret playbook. After that, we'll get into the deep stuff, what a stock is really worth and how on earth investors even calculate that. We'll also look at those wild moments when pure hype just throws all the rules out the window. And finally, we'll piece it all together so you can see this as a powerful tool. Sound good? Let's go. Okay, first up, the price flicker mystery. To really solve this thing, we need to look at it from two different angles. There's the how, that's the nuts and bolts mechanics of the price changing every second, and then there's the why, the big picture reason a stock has any value in the first place. Let's kick things off with the how. This is the fast and furious part, the second-by-second action. Think of this as the engine room of the stock market. It's the very thing causing that constant flicker you see on the screen. And at the very heart of all this action is something called the order book. Seriously, this is like the market's secret playbook. It's a live, totally transparent list of every single offer to buy a stock, those are called bids, and every offer to sell it, we call those asks. This thing is the literal pulse of the market. In this slide right here, it perfectly captures this constant battle. On one side, you've got the bids. It's a sea of green numbers from buyers, all shouting, "I'm willing to pay this much." On the other side, you've got the asks, a wall of red from sellers saying, "Nope, not selling for a penny less than this." And the stock price you see on the news, that's just the last handshake, the most recent price where a buyer and a seller agreed. So here's where it gets really important. How does this tug-of-war actually move the price? Well, when buyers get super excited and there are more of them than sellers, it turns into a bidding war. Everyone's trying to one-up each other, and that frenzy sends the price soaring. But what if some bad news hits? Well, then it's a mad dash for the exits. Sellers start slashing their asking prices, creating a huge sale that drives the price down. And that, in a nutshell, is the how. Okay, so we've got the fast-paced how down. But now, let's pull the camera back. Let's tackle the much bigger question. Why is a stock worth, say, $5 or $500 in the first place? This is where we get into the why. To answer that, we have to talk about a really key concept, intrinsic value. This is the estimated true worth of a company. It's based on solid stuff, its earnings, its assets, its potential for growth. It's what the price should be if you could just tune out all the daily noise and market panic. It's the signal hiding in all that static. But, and this is a really big but, intrinsic value is an estimate. It's not some magic number that everyone agrees on. It's subjective. So you could have two of the most brilliant investors in the world look at the exact same company and come up with two very different intrinsic values. It's part science, part art. So if it's an estimate, how do investors even try to figure it out? Well, they've got a whole toolkit of methods they use, and each one looks at the company from a slightly different angle to try and nail down its true worth. These are pretty much the four big ones in that toolkit. You've got discounted cash flow, the dividend discount model, asset-based valuation, and things like earnings multiples. Now, because no single tool can give you the whole picture, the smartest investors will use a combination of these to get a much clearer, more three-dimensional view of the company's value. All right, let's quickly demystify the most famous one, DCF. I know, it sounds super complicated, but the logic behind it is actually pretty simple. First, you try to guess how much cash the company is going to make in the future. Step 2, you discount that future money. Why? Well, because $1 today is worth more than $1 5 years from now, right? So you adjust those future profits to figure out what they're worth today. Step 3, you add a guess for the company's value way out in the future. And finally, step 4, you just add it all up. That number you get is your best guess at the company's intrinsic value. And now for the plot twist. We've talked about the logical mechanics and the fundamental value. But what happens when the market just goes a little bit crazy? What happens when a stock's price seems to completely disconnect from reality? This is where the messy, unpredictable human element comes crashing onto the stage. This quote from Warren Buffett is just perfect. It says, investing is like buying a farm. You look at its soil and crops, not what the neighbor paid yesterday. That just nails the idea of value investing. You focus on the real, underlying quality of the business, the intrinsic value, and you try your best to ignore the daily market gossip. But that brings up a huge question, right? If smart investors are focused on the farm, then why do we see some stock prices shoot off into the stratosphere, way beyond what any calculation says they should be worth today? Well, it really boils down to the power of perception and expectations. First, you've got market sentiment, sometimes just pure collective emotion, whether it's wild excitement or total fear, can completely steamroll the fundamentals. Then there are future expectations. For a lot of tech or biotech companies, investors aren't buying today's profits. They're making a massive bet on a world-changing discovery years from now. And finally, you have big external factors. Things like low interest rates can make stocks look way more attractive than other investments, pushing prices up everywhere. Okay, let's bring it all together. We've seen these two powerful and often competing forces at work, the super-fast mechanics of the market and the slow, steady fundamentals of a business. And this table just lays it out perfectly. On one side, you've got the how, the mechanics. That's all about the order book, short-term supply and demand, and the things that cause those price flickers. It's driven by news and hype. On the other side, you have the why, the fundamentals. That's all about intrinsic value, long-term company health, and real growth. You can think of the why as a heavy anchor holding a ship in place, while the how is just the choppy waves on the surface. So, if you remember one thing, make it this. A stock's price isn't just one thing or the other. It's the result of this constant, epic battle between the solid ground of a company's real value and the wild, unpredictable mood swings of the market. And here is the final, crucial piece of wisdom. Understanding intrinsic value, it's like a superpower for spotting potential bargains, but it is not a crystal ball. The market can ignore facts and stay irrational for a really, really long time. It's a powerful reminder that the fundamentals don't always win in the short term. So now you have the toolkit. The next time you see a market headline about a stock soaring or plunging, you can look past the noise. You can ask yourself, am I just seeing the short-term mechanics of a bidding war at play, or am I seeing a real shift in the company's long-term fundamentals? Trust me, the answer to that question will change how you see the market forever.